Welcome to the Deep Dive. Today, we're digging into a really fascinating paradox. We're looking at a company that delivered what looks like a perfect earnings report, but it somehow led to a pretty steep market sell-off.
Exactly. The company is Evolv Technologies, ticker EVLV, and we're focused on their Q3 2025 earnings call from back on November 13th.
Right, so on the surface, the numbers looked like an absolute home run. Massive beats on revenue, huge beats on profitability.
And yet the very next morning, the stock just tanks. It drops 8.8% on really high trading volume.
So our mission today for you is peel back those layers.
Yeah.
We want to figure out what the market was actually focusing on versus what the management team was highlighting.
It's all about separating that strategic music from, the accounting noise.
Okay, so let's start with the highlights because they were genuinely stunning. Top-line revenue for Q3 came in at $42.9 million.
Which is a massive 57% surge compared to the year before. I mean, it crushed consensus estimates by 27%.
In this kind of market, for a high-growth company, those are the numbers that should send a stock absolutely soaring.
And it wasn't just the top line. They showed real progress on profitability, too. Their non-GAAP adjusted EPS, it was a loss of just 2 cents.
Right, and the street was expecting a loss of 7 cents. That's an 85% surprise. It shows some real operational control.
It really does. But the big milestone, the one management really wanted to talk about, was profitability. They hit positive adjusted EBITDA of $5.1 million.
Which gives them a 12% margin for the quarter. And this is huge because it's their fourth consecutive quarter of being positive on that metric.
Exactly. 4 quarters in a row, that's a trend. That suggests they're on a path to being self-sufficient.
So why the pessimism? Why the almost 9% drop?
Well, the skepticism immediately zeroed in on let's call it the quality of that 57% revenue growth. The market took one look at that number and assumed it was, inflated.
And I think we have to respect that suspicion. You often say that for these kinds of companies, predictability is everything. So let's get into that $42.9 million number. Where's the noise?
Okay, so about 70% of it, or $30.1 million, was recurring revenue. That part grew 27% year over year. That's solid.
That's very solid. The core business is growing well.
It is, but the problem is in the other 30%, the non-recurring revenue, it just exploded. It surged 254% to hit $12.7 million.
Whoa. So when your one-time revenue is growing 10 times faster than your core subscription business, that's a red flag.
It's a huge red flag for analysts. They start discounting that total growth figure immediately because it just doesn't feel sustainable.
To their credit, management was transparent about it. They basically confirmed the market's fears, right?
They did. They laid out about $7.5 million in items that were essentially one-time windfalls that padded the Q3 number.
Let's break those down because this seems to be the key to the whole story.
Okay, so item 1, their largest contract ever. It was with Gwinnett County Public Schools. That deal contributed about $3 million in the quarter.
And most of that was recognized immediately as product revenue, not subscription.
Exactly. It's because of the accounting rules around delivering the hardware upfront. So, great customer, but lumpy revenue.
Okay, what's item 2?
Another $3 million. This was tied to IP licensing and other one-time revenue connected to their legacy distribution model.
The old model they're trying to get away from.
The very same one. So this is basically revenue from a business structure they're phasing out.
And the third piece?
About $1.5 million from short-term rentals or subscriptions. Management themselves called these episodic, not the long-term predictable contracts they want.
So if you just strip out that $7.5 million in, let's call it, lightning in a bottle revenue.
Then the normalized revenue growth, as management pointed out, is closer to 30% year over year.
Okay, so 30% is a much cleaner, more believable number, but it's a world away from the 57% headline figure.
And that gap. That's the first piece of the puzzle. Investors saw the 30% number and felt the 57% was just a distraction.
That makes sense. Analysts hate having to do the math themselves. But there was a second, maybe even bigger problem. The gross margin.
Oh, yeah. If the revenue story was noisy, the margin story was alarming. Adjusted gross margin just plummeted. It went to 51%, all the way down from 64% in the same quarter last year.
That's a 13-point drop. That is severe. If that was from pricing pressure, the stock would have been hit even harder.
It would have. But management says the drop was mostly due to a strategic pivot.
Wait, so they're saying they did this on purpose? That they intentionally let margins fall that far? That sounds a little defensive.
It does, but this is the core of the deep dive. The drop is tied to their big strategic shift. They're moving away from that legacy distribution model where a third party handles fulfillment to a direct purchase model.
And that change triggers some specific accounting rule.
Yes, ASC 606.
Can you just briefly explain that? For those of us not deep in corporate finance, what does that rule make them do?
Sure. ASC 606 is all about how you recognize revenue from contracts. In Evolv's new direct model, when they sell the hardware, the physical scanner, they have to recognize the revenue and the cost for that hardware immediately when it's delivered.
Ah, I get it. So even if the customer signs a 4-year subscription contract, the full cost and revenue of that big physical machine gets booked on day one.
Precisely. And since the hardware itself has a much lower margin than the high-margin software subscription, booking it all up front just crushes your reported gross margin percentage for that quarter.
So it's a temporary distortion. It makes the short-term picture look worse, even if the long-term deal is actually better.
That's the argument. A short-term headwind that makes the numbers messy.
But that wasn't the only thing hitting margins, was it?
No, they also had about $3 million in one-time inventory and service adjustments. More cleanup from the transition. And they mentioned the new eXpedite product is still running at subscale manufacturing costs, so it's more expensive to build right now than it will be in 2026 when they ramp up.
Okay, so a messy P&L. But despite that, the balance sheet actually looked pretty strong.
Very strong. They showed real operational efficiency. Adjusted operating expenses actually went down a little bit year over year to $24.8 million.
Which is incredible when you consider how much they grew their base of deployed units.
And the cash story is the most powerful part. Their cash position grew to $56.2 million. And here's the kicker. Operating cash flow for the first 9 months turned positive. Positive $3.1 million.
Wow. Compared to what, last year?
Last year, over the same period, they burned $34.1 million.
That is a massive turnaround. Going from burning cash to generating cash, that shows serious operational leverage.
It does. It shows they're really professionalizing the business.
So let's go back to that strategic pivot. Why go through all this accounting pain? You said they're trying to capture more ARPO. What's that?
ARPO, or average revenue per unit. By going direct, Evolv now gets 100% of the contract value over that 4-year term. They cut out the middleman.
So they get more recurring revenue, or ARR, from every single unit they deploy.
Exactly. It leads to much higher cash flow and a higher lifetime value per customer.
So they're taking a short-term hit on the reported margin percentage to lock in a higher, cleaner, more predictable cash stream for years to come.
That's the thesis. And their recurring metrics seem to back that up. Their annual recurring revenue, ARR, hit $117.2 million. That's up 25% year over year. That's the real engine of the business.
And the backlog, their RPO.
Also very strong. The remaining performance obligation, or RPO, is about $299 million.
And for you listening, RPO is just the future revenue they've already locked in under contract but haven't booked yet. It's a measure of future stability.
Right. And it grew 8% just from the prior quarter. That gives them multi-year visibility.
Management used a specific phrase here, didn't they? Something about an inflection point?
They did. Very deliberate. They said 2026 will be an inflection point. They know that ARR growth at 25% lagged the total revenue growth of 57% this quarter. But they expect in 2026 that ARR growth will finally outpace total revenue growth.
Meaning the one-time noise goes away and the subscription engine finally becomes the main story.
That's the promise.
It's a bold promise. But let me push back a bit. If the goal is quality, why did they guide 2026 revenue to only $165 million? They said themselves that this shift is deferring $5 to $10 million of revenue out of 2026. Isn't that risky?
It's risky from a headline perspective, but it's the whole point. They're telling you to expect lower headline growth because they are actively converting those lumpy sales into long-term ARR. They're basically telling the market, stop looking at the total revenue number. Look at the ARR quality.
So a lower headline growth number for 2026 is actually a sign of improving health, not slowing demand.
If you believe the thesis, yes. And their product momentum suggests demand is anything but slow. They added over 60 new customers in Q3. They're pushing new software releases. They're really trying to act like a SaaS analytics company.
And the new bag scanning product, eXpedite, is a big part of that.
A huge part. They added 12 new eXpedite customers, but here's the key detail. 11 of those 12 also bought the core Express product.
So the bundle strategy is working. They're locking customers into the whole platform.
Exactly. And to support all this growth, they announced a new manufacturing partnership with Plexus.
Which is meant to help them scale and fix those subscale manufacturing costs we talked about earlier.
Right. It's a proactive move to address the margin problem head on.
Okay, so let's bring it all back to the investor. Management raised their full year 2025 guidance to between $142 and $145 million.
A big raise. And they made one huge promise. They committed to being cash flow positive in Q4 2025.
Hitting that goal would be a game changer. It proves they don't need to raise more money to fund this transition.
Absolutely. It would dramatically de-risk the story for investors.
So now we can really explain that 8.8% sell-off. The market focused on two things: that scary visible margin drop from 64% to 51%.
And the fact that the amazing 57% growth was padded with $7.5 million of one-time items. The immediate reaction was just, the quality of these earnings is questionable right now.
And you have to remember the context. EVLV is what we call a high beta stock.
Meaning it's way more volatile than the overall market. It was up over 130% in the last year. It had just hit a 52-week high. A lot of people were sitting on big gains, and the margin news gave them the perfect excuse to take some profits.
So what we're left with is a classic transition story. A high-growth company is making a structural change for long-term health, but the short-term accounting looks, well, messy.
It creates a high-risk, high-reward scenario. The market is pricing this margin dip like it's a permanent failure, but management says it's a temporary feature.
Which brings us to our This Is Not Financial Advice segment. Given that the market might be overreacting to what is essentially a planned, self-inflicted accounting wound, we see a potential opportunity here.
The whole trade is a bet on management's execution. We're looking at a long position, but using near-term, deep-in-the-money call options that expire in Q1 of 2026.
Okay, so for those who aren't options traders, deep-in-the-money calls are a leveraged way to bet on the stock going up, but with less of the time decay risk you get with other options.
The rationale is very specific. The trade bets that the market will immediately re-rate the stock once the company reports that they hit their Q4 cash flow positive goal. That news should come in early 2026.
And if they also show that ARR growth is accelerating and finally outpacing total revenue growth,
it validates the entire transition. The perception could shift overnight from lumpy hardware seller to predictable subscription platform.
And if that happens, the stock price could move quickly toward that analyst consensus target, which is around $9.80 right now.
It's an aggressive bet for sure, but the underlying metrics, the RPO, the ARR growth, that cash flow turnaround, they suggest the foundation is there.
The compelling turnaround story. So to wrap up this deep dive, the Q3 story for EVLV really has two sides. You have explosive headline growth driven by some big one-time wins.
And that's set against a strategic pivot that's creating severe but probably temporary complexity in their gross margins.
Management is making a very clear trade-off. They're prioritizing long-term recurring revenue quality over short-term revenue spikes.
And the underlying demand for the product, based on unit growth and that huge backlog, it seems to be very, very durable.
So the core takeaway here is that the noise might be temporary, but the shift to a cleaner, high-quality subscription model is meant to be permanent.
Right, if they can execute.
So to leave you with a final thought to mull over, management said they expect to add more new units in 2026 than they did in 2025.
Yeah.
And remember, 2025 included their largest contract ever.
And you have to layer on their regulatory credibility. They have these DHS Safety Act designations, which is a huge stamp of approval for their tech. So considering that momentum and that credibility, how many more of these massive 100+ unit contracts does Evolv need to announce before the market finally looks past this temporary margin headwind?
That's the real question. Momentum versus skepticism. That's definitely something to think about. Thanks for joining us for this deep dive. We'll catch you next time.